Hello, I'm Lelda Smits for the Finance News Network, and joining me today from Westpac is its Chief Economist, Bill Evans. Bill, welcome back to FNN.
Thanks, my pleasure.
Let's start with interest rates. The RBA kept the key cash rate on hold at a record low of 2.5% at its first board meeting of the year. Where do you see interest rates heading over 2014?
Look, the consensus view is that the RBA's next move will be up in rates. I think the market's pricing in about an 80% probability that rates will be up early next year. My view is a little different. I think that there's still a number of uncertainties in the economy that may indeed lead to the requirement that rates have to come down further.
You mentioned rates will head lower. When do you think this will occur?
Well, I think if generally if the decision to cut rates is made, typically you won't do that just to do one, because it would be a huge reversal in terms of where the Reserve Bank is thinking at the moment. They're thinking that the next move will be up. To turn around and have to cut rates, you wouldn't do that if you thought that the economy only needed one cut. So I think if we do see that process evolving, then there'll be a couple of cuts at the end of the year.
So Bill, where do you see the key cash rate sitting by the end of this year?
Well, that would be 2% cash rate.
The RBA has recently pulled back from claiming the Australian dollar is too high. What's your forecast for the local currency?
Because I think interest rates can come down in the second half of the year, I would see the Aussie dollar down around 85 cents by the end of the year. The other big dampening factor on the Australian dollar is going to be a fall in the terms of trade associated with weaker demand from China, and also improved supply of commodities in response to the high commodity prices that we've had over the last few years. Combination of that squeeze on commodity prices and the weakness in China likely to see the Aussie dollar also have some downward pressure. So lower interest rates and a fall in commodity prices will be the things that will drive the Aussie down. But I don't see that evolving certainly until the second half of the year, when the China story becomes more clear and when we see lower rates. If we don't see lower rates, then the Aussie dollar could well hold for a lot longer.
Now, looking abroad, China's latest trade data has exceeded expectations. Are you bullish or bearish about the nation's economic prospects?
Generally speaking, I think the new management, the new government in China is focused on rebalancing the economy away from investment and infrastructure towards consumption. That means that they have to accept a lower growth profile. That means that a number of producers that are not complying with general standards and are lowering China's confidence in consumer goods will have to leave the market. It means that the safety net will have to be expanded. That's money going into pensions, going into health and education. Growth multipliers on those are a lot lower. So I would expect that the Chinese growth profile will be in the low sevens rather than the mid to high sevens. It seems to be the consensus, and we'll feel that.
Now, you say we'll feel that. Could you elaborate on exactly what we'll feel?
Well, we expect to see further falls in commodity prices and the terms of trade. The iron ore price has currently fallen quite quickly, down to around $120 a tonne. We're looking for 110. I think there'll be more downward pressure on the coal price. Australia's competitiveness in the coal market is poor. We are a high-cost coal producer. China is clearly wanting to move away from coal from environmental reasons. Other producers are coming into the market that are cheaper and more efficient. So the combination of those, I think, would represent some downward pressure, not only on prices but also on our capacity to deliver.
And finally, Bill, the S&P ASX 200 index has posted a soft start to the year after gaining about 15% last year. Where do you see the key benchmark trading and ending this year?
We're reasonably optimistic about the share market. We feel that companies are still in that process of improving their productivity, of improving their earnings as a result of cost control. And to some extent we'll see some revenue growth as well. But to me, the key dynamic that has supported share markets in the last few years has been strong earnings growth associated with productivity, doing things more smartly, doing without labour to do things, and I think that'll be the key driver. And so I think about a 5 to 10% jump in the share market next year. This year is quite achievable.
Good to finish on a positive note. Bill Evans, thank you for your insights.
Thank you.